Good morning, everyone, and welcome to Business Finance in this semester's class. Hope you all are doing well. Each week, I will be providing a brief walkthrough of each of the PowerPoints for each chapter. I'm not going to go over every slide, but just hit some high points or some things that I feel like need either further explanation or I can provide a little real-world examples, some of those things. So, for the sake of time, there will probably be a little bit under 15 minutes, hopefully, each for each chapter, and I will walk through that. So here we go with Chapter 1. So this week we are talking about different forms of business organization, how to maximize a firm's wealth, different determinants of fundamental values, financial securities, markets, and institutions. Pretty simple stuff. Why do we look at corporate finance? Why is it important to all of us, right? So corporate finance does give what managers need to be successful. We have the data, we have the information. So we can identify and select strategies to improve projects and add value. We can forecast the funding requirements, that's a big piece, and then come up with strategies to acquire these funds. And we'll get into that in this chapter and the next. So this is probably stuff you've seen before in Business 101, but we'll go back through it. We've got what type of business organizations there are. We've got sole proprietorship, partnership, and corporations. And I'm going to go through this section pretty quick because I'd rather focus later in the chapter. So advantages of starting a proprietorship. Ease of formation, few regulations, no corporate income taxes. Disadvantages. Limited life. When the owner dies, so does the business, unless it's willed on or so forth. Unlimited liability. If the business goes under, so does the ownership's financial situation. And it's difficult to raise capital, right? You either have to have money on your own or get folks individually to invest or get loans on your own, so it's definitely harder to raise capital. Partnership has basically the same advantages and disadvantages. You may have some shared liability with a partner, but at the end of the day, if the partner's not able to pay the debts, you're still responsible. So very similar as far as advantages and disadvantages. Corporations, they are a legal entity. Basically, I say they are basically a living, breathing organism, right? They're their own thing. They're separate from their owners and managers. You have to file papers of incorporation with each state that you operate in. There are charters and bylaws that you must have in place. So this takes a bit of time and a bit of effort. Advantages, unlimited life, right? Since the owners and the employees are not attached to the business per se, as they pass or move on into different roles and parts of their lives, the business keeps rolling on. It's easy to transfer ownership. Buy and sell stock in a company. You can move it easily from one person to the next or from one group to the next. There is a very limited liability, right? You're only in for the amount that you invest in the company. And then ease of raising capital. It's not simple, of course, but corporations can sell stock. They can do different things to raise capital. Obviously, it's easier for them to get funding from different financial institutions and so forth. Some of the different disadvantages for corporations, there's double taxation. What do we mean by that? Well, I mean that the corporation itself is taxed, but also the shareholders are taxed. The people that invest, the owners of the company, they invest personally. So there is double taxation there. And there is a cost of setup and report filing. So it's obviously there are costs associated with that. So when you become a corporation and you want to grow, the first thing you're going to do is have an initial public offering, an IPO. You'll hear about this on CNBC or in financial news when companies are just putting their stock out there to be sold. A recent one was, I think, Blue Apron is what it's called. They recently went out with an IPO. Sometimes these IPOs come out and the stocks are cheap and they go up really fast, and sometimes it's the opposite. It sells a little bit higher than it should have, and the market will bring it back down to the correct value. Not to go too deep on this, but this is a quick way for corporations to raise cash. It allows the founders and pre-IPO investors to harvest some of their wealth, right? And then there are later down the road they can issue more debt and gain more equity through additional stock offerings and other methods, which we'll talk about. So, agency problem, it's a big word, but basically what it really means is it's one of the problems that corporations have, is that managers sometimes don't act in the best interest for the owners, which is actually the stockholders and the shareholders in the company. They may act in their own interest, right? If I'm a manager for a specific department and I know if I hit my numbers I get a bonus, even though it may not be the best thing for the corporation as a whole, I'm still going to hit those numbers. That's human nature. So that's what we talk about when we talk about agency problem, is when the managers are acting in their interest and not on behalf of the stockholders. Right. So how do corporations attack this? Basically, they have governance, sets of rules, behaviors. I would also put in there incentives. All right, how are the employees and managers incentivized? Does it line up with the corporate goals that senior management has laid out, working with the board of directors to achieve long-term growth, long-term goals, which in turn is going to help stockholders. So those things are put in place to keep this problem from being a big issue. All right. So the primary objective of any corporation is to grow shareholders' wealth, and that should also be management's basic goal, right? So when we look at this basically in turn will raise a stock price. As the stock rises, shareholder wealth rises. As long as everybody's objectives are in the same direction for a corporation, that's the way it should be going. Now, there's a question here. Should firms or should corporations behave ethically? Do they have a responsibility? Right? If we say that a corporation's sole purpose to exist is to grow shareholder wealth, then we could say they don't have to behave ethically. But I disagree with that, and so does the book, and so does anybody's teaching across the board. Acting ethically will create shareholder wealth. Doing the right thing will ensure long-term growth and stability for corporations. So acting ethically and doing the right thing is always the right thing to do for a corporation. And I always say this, and I've taught many ethics classes, one thing I say is it's never going to cost you any money to do the right thing. It may cost you in the short run, because there may be a cost associated with it, but in the long run, you're going to be better off. All right. Now let's get into cash flow. What are 3 aspects of cash flows that affect an investment's value? Right. So basically, what parts of cash flow impact stock price would be another way to look at this. So the amount of expected cash flows, is it bigger, is it better? Are we selling more? Are we selling new things? Are we selling to different people? Timing, so when is the cash flow coming in? Investors always like money now, not later. So when they see the money coming in earlier versus later, they like that. And then risk of the cash flow. That could be within the company, it could be within an industry, it could be within an area of the country that they're operating in, or of the world for that matter. So that could be macro or micro issues. All right, so free cash flows. They are cash that is available for distribution to all investors. So basically, when you take out everything, what's left over that we can put back in to our investors, right? So free cash flow is sales revenue minus operating costs, minus operating taxes, minus our required investments for operating capital. So what do we have to do to keep it running? Is that basic last bullet point there. That's how you calculate free cash flow. We also hear about weighted average cost of capital, right? This is impacted by the capital structure, interest rates, risks, and overall attitude towards risk. Those are 2 big pieces of the puzzle we're going to talk about here. So when you think about it, what is a firm's fundamental or intrinsic value? Really, what do people really think this company's worth? And it's just simple. Over the course of the years, it's the free cash flow divided by the weighted average cost of capital, and you can see the calculation here. This is a great chart, and I'm not going to walk through all of it, but this is a great way to see, hey, here are the pieces of the puzzle for free cash flow. Here are the pieces of the puzzle for weighted average cost of capital, and you can see how this all comes together to get a firm's value and what it's really worth. So the cost of money. What do we mean when we talk about the cost of money? Right? We basically say it's the price or the cost of debt capital, the interest rate. That's what it's going to cost us to raise debt capital. We talk about what is the cost of equity. The cost of equity is the required return, which equals the dividend yield and the capital gain. It's a lot of words, a lot of stuff, but still pretty simple. And I think as you read through the text, you won't have any problem with that one. 4 factors that affect the cost of money: production opportunities, time preference for consumption, risk, and expected inflation. And I think a lot of those are going to be a mix of macro and microeconomics that are coming into play. What economic conditions affect the cost of money? Federal Reserve policies, budget deficits, business activity, and international trade. These are big hot topics right now across the country. All things that we're hearing about daily, especially trade has been a big hot button recently. So as you are watching the news and listening to the news, this will be easy to relate back to what you're learning here in the class. But these definitely all impact the cost of money. What are different financial securities? The books will tend to use the word securities in place of stock or in place of bonds a lot. So if you see that word, don't get confused. It's just a big word for different types of stocks, bonds, CDs. You can see all the different options here. And then you have your derivatives with options, futures, forward contracts. And we'll get into these later as we go throughout the course, but just wanted to list those out here. What are some financial institutions? This should not be new to you guys. Commercial banks, investment banks, savings and loans, life insurance, pensions funds. This one I could have skipped for you, but I will move on. All right, what are some types of markets? A market is basically where you're exchanging an asset for another. You have physical assets, you have financial assets. Spot versus future markets. So spot is going to be what is it worth today, and then future, obviously, what is stock or a bond worth in the future. Money versus capital, right? People trade in money currencies. That's really what that is looking at. And primary and secondary. And we'll see that here in a second. So primary, when you have new issued stocks, IPOs, and then this is when the issuer receives the proceeds. So company A goes with an IPO, they get the money that the people invest, right, and the proceeds from that sale. Secondary is when an existing owner sells to another party. If I'm an investor and I own stock in company A and I sell it to another investor, I get the proceeds. That's secondary market. So types of orders: market order, as quickly as possible, right? Here's what it's worth. I want to buy it right now. And then a limit order is basically when I set I put out a set of criteria and I say, hey, if this stock gets to this price, I want to buy or I want to sell during a certain time frame. So that's a limit order. So you've heard about the New York Stock Exchange. You've heard about NASDAQ. So let's compare the two. New York Stock Exchange is the oldest. NASDAQ is a little bit newer and has the most listings because it's willing to list smaller companies. So New York Stock Exchange has bigger, larger market value companies. The NASDAQ has smaller ones. A lot of times they have growth stocks as well. So you can see that here. How many number of listings, their market value, and you can see the big disparity between the two. Quickly, we're going to get into home mortgages, and I'm actually going to pause the video and then do a part B here so we don't run out of time. So I will come back with part B of chapter 1.